Interest rates in Canada. How do they work and affect you? Understanding interest rates in Canada. Interest rates. We hear about them all the time. When they go up, when they go down, but most people fully don't understand how they're set or the impact they have on their financial lives. In Canada, all interest rates start with one source, the Bank of Canada. Whether it's your mortgage payment, your line of credit, the return on your GIC, or even your retirement plan, it all traces back to the decisions they make. In this video, I'll walk you through the role of the Bank of Canada and its responsibilities, what policy interest rate is and how it works, the prime rate and how it's connected, how interest rates affect nearly every area of your financial life, from borrowing and real estate prices to investment and retirement. Welcome to the channel. My name is Eric Silvaggi. I'm a wealth advisor with Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please subscribe and click the like button. The Bank of Canada's role. The Bank of Canada is our country's central bank. It doesn't operate like a regular bank. You can't open a checking account there. Instead, it's responsible for keeping our financial system stable and our money's value protected. Its five main areas of responsibilities are monetary policy, setting policy interest rates to keep inflation low, stable, and predictable. Financial system stability, ensuring banks, markets, and payment systems operate smoothly. Currency, designing and distributing Canadian banknotes and ensuring they're secure. Funds management, acting as a banker for the Government of Canada and managing financial assets. Retail payment supervision, overseeing payment service providers to keep transactions safe. Today, we're focusing on the first role, monetary policy, because that's where interest rates come in. The policy interest rate, also called the overnight rate, is the interest rate at which major Canadian banks lend money to each other for one day. The Bank of Canada adjusts this rate to influence borrowing, spending, and inflation. If the economy is slowing, they lower the rate to encourage borrowing and spending. If inflation is high, they raise the rate to cool down the economy. Changes to the policy rate rippling through the economy, affecting everything from mortgage rates to savings and account returns. The prime rate. The prime rate is the interest rate commercial banks charge their most credit-worthy customers. It's closely tied to the policy interest rate. When the Bank of Canada changes its rate, the prime rate almost always follows, impacting products like variable rate mortgages, lines of credit, business loans. How interest rates impact your life. Let's look how interest rate changes show up in your day-to-day financial life. Borrowing money, variable rate mortgages. When policy rates rise, your lender's prime rate goes up, increasing your interest cost. Your payment might increase, or more of it might go toward interest instead of principal. If rates fall, you could pay less interest and pay off your mortgage faster. Fixed rate mortgages, influenced by bond yields, which move with interest rate expectations. Higher rates can mean more expensive renewals. Lower rates can create opportunities for cheaper borrowing. Lines of credit, almost always tied to the prime rate. A change in policy rate can quickly raise or lower your interest costs. Real estate prices. Higher rates make borrowing more expensive, cooling housing demand and slowing price growth. Lower rates boost demand and can drive prices higher. Investing. GICs, guaranteed investment certificates. Rising rates make new GICs more attractive with higher yields. Older, lower rate GICs won't benefit from newer rates. Bond market. Higher rates mean new bonds pay more. Existing bonds with lower coupons lose value. Bond funds may see price declines in a rising rate environment. Stock market. Rising rates make borrowing more expensive for companies, potentially reducing profits and share prices. Investors may shift money from stocks to fixed income when yields become more attractive. Retirement planning. Interest rates affect returns from low-risk investments and borrowing costs. They also impact inflation, which affects your purchasing power over time. If you're retired, raising rates could mean higher income from savings and GICs, but more volatility in your equity portfolio. The big picture. Interest rates touch nearly every corner of your financial life. That's why you can't set a financial plan once and forget it. You need to update your plan regularly, considering how rate changes affects down payments, investment returns, real estate plans, retirement goals. The Bank of Canada will continue to adjust rates based on inflation and economic conditions, but it's up to you to prepare for those changes. Understanding how interest rates work isn't just for economists, it's a tool for protecting your financial future. If you know how rate changes affect your borrowing, your investments, and your long-term plans, you can make smarter decisions and stay ahead, no matter what direction the Bank of Canada takes. Thanks for watching. Make sure to subscribe for more financial insights that may impact your day-to-day life.